Hello class, welcome to this chapter 9 handout answer video. Hopefully you have looked at the handout, you have attempted it, okay, and hopefully you've gotten it entirely correct and you're just here to reaffirm the good work that you've already done, okay? So let me get it pulled up here, shared with you, and we'll get started. And once again, I am not going to pull out a journal sheet. However, if you printed out the journal sheet and you like using that better, that is great. And it's okay that you use one. But I'm just going to write journal entries up here. Just imagine that they are lined, okay? Let's draw here. First, we're going to record the issuance of some bonds, okay? So if we record them at par, what that means is we are actually going to receive the face value of the bonds as cash. There's no difference between the market rate and the stated rate, which is the stated rate here is 7%. So to figure out how much cash we're going to get, we're going to have 8,000 bonds, $1,000 face value for each of them. So our total cash here is going to be $8 million. So we issue them at par. We'll debit cash for 8 million. And we will credit bonds payable for 8 million. Bonds payable always at face value. Remember that is important, okay? So when we issue at 103, we're still going to debit cash here, right? But now we issued at 103. 103 means we are receiving 103% more. The cash we're going to receive is 103% of face value, I should say. Okay. When we receive more cash than the face value, that means we are selling at a premium. And that must be, we are selling at a premium because the market rate is lower than the stated rate. The market is paying less, giving less return than what we are. So everybody wants our bonds, so we sell them at a premium. So you take the 8 million times 1.03 or 103%. You see that the cash we're going to get is 8,240,000. Okay, premiums are a normal credit balance. So I'm going to go ahead and record them over here, but I'm going to record my bonds payable first. BP for bonds payable, always, always, always at face value. And then we have this new account, this premium on bonds payable for the difference. The premium amount here was $240,000. Okay, next, when we issue them at 96. 96 means we are only receiving 96% of the face value as cash on the day that we issue those bonds. The reason being for that is maybe now the market is paying a higher percent. The market might be paying 9% interest. So nobody is going to only want 7% interest from us unless we give them some incentive. So we sell them at a discount. We sell them at 96. So when you take the 8 million times 0.96, you'll see we get 7,680,000 in cash. Okay, I'm going to skip a line and tell you bonds payable always goes on the credit at face value for 8 million. So here our discount is going to have a normal debit balance anytime we issue for less. So we have a discount on bonds payable via our account, and it'll be $320,000 would be the total discount. And there's how you record the issuance of bonds, whether at par, at a discount, or at a premium. And then we're going to see in the next question, this premium or this discount, we are going to take away through a straight line amortization method, which we'll go through here in problem number 2. All right, so here we have Swiss Inc. sold 15-year bonds with a total face value amount of $1,800,000 and a stated rate of 8%. The bond sold for $1,887,000. Okay, so what did we have here? Okay, we received more cash than the face value. So we are going to have a premium. Okay, so we're going to be working with a premium here. What was the stated rate was 8%. So if we're having a premium, what could the market rate have been? Had to be lower, right? The lower market is giving a lower return than us. So we sell ours higher. Everybody wants them. We get that premium. So do we recognize the sale of the bonds here? Well, be the journals just like we had before. We received cash on that day of 1887. Okay. The bonds payable, the BP here, always recorded on the books in our journal entries at its face value. And since we got more cash here, we will credit the premium on the bonds payable by $87,000. Okay, next it says determine the amount of semi-interest payment required by the bonds. Okay, when we're talking about payment here, okay, concerned how much cash are these bonds going to have to pay out every 6 months? So our cash equals our face value times our percent times 1/2 or divided by 2. And that's because they're semi-annually. That's 6/12, half of a year. Okay, you can just break it down into that a little bit lower. And you're going to see that we're going to pay out $72,000 in cash. Okay, so now our next one. Prepare the journal entry made by Swiss at June 30th to recognize the interest expense and the interest payment. Okay, so we're going to have a debit here to interest expense, then I'm going to skip a line. Then we're going to have a credit to cash. Okay, when we make this entry though, we also need to look at if we have a discount or a premium. In this case, we have a premium. So we need to amortize that premium off. Okay, so you can see when we first did it up here, we put it as a credit. So to make it go away, we need to put it as a debit. So we're going to do a premium bonds payable as a debit also. Those are our 3 accounts. Okay, you're always going to have interest expense and cash. Okay, if it was a discount, if you still left that line blank, it'd be fine because you would just move it over to the credit. You would credit a discount in this case. Okay. So right above it, we calculated the cash, so we can fill that in. Okay, the next thing we need to calculate is the amortization amount. In order to get that, we take our total premium or discount. In this case, it's a premium though. And we divide it by our total interest payments. In this case, okay, our total interest payments, we had 15-year bonds semi-annually. So we would have 30 interest payments, 15 years, twice a year. And that will come out to $2,900. That's the amount of the premium that we are going to remove each time we make an interest payment. So we take $2,900 over here, making our interest expense lower at $69,100. Now, the general concept I want to drive home here that you're going to need to know for your test is that whenever you have a premium, interest expense is lower than cash, as you can see. Now, if we had a discount, I don't have a problem to go through with a discount. It's the exact same process, only the discount is a credit entry. So the discount is going to make your interest expense higher than the cash paid out. Okay. And it says determine the amount of interest expense for 2024. Or under the straight line method, this journal entry is going to be made every time we make a payment. Okay. So your interest expense is going to be 69,100 twice a year. So interest expense for a year on those bonds comes out to 138,200. Okay, so hopefully that'll help you get through the accounting on chapter 9. Seeing these problems worked out will make that make sense on how a discount receives lower cash up front, but creates a higher interest expense than the cash paid in order to make up for it. Whereas a premium receives more cash up front, but it lowers its interest expense over the life of the bonds to account for that extra funds it received. Okay, so that is it for chapter 9. Good luck to you. Definitely reach out to me if you have any questions. And then we'll be on to chapter 10, your last one for this semester.